There is a financial institution that manages more money than most hedge funds, operates with almost no regulatory oversight, charges no fees to external investors, and has never appeared in a financial news headline. You have almost certainly never heard of it. And the family that owns it has almost certainly never wanted you to. That institution is a family office. Welcome back to Capital Above Convention. Today, we're going deep on one of the most powerful and least understood structures in global finance, the family office. What it is, how it works, why the ultra wealthy use it, and what it tells us about how serious money is actually managed at the highest levels. A family office is a private wealth management firm that serves a single ultra high net worth family, or in some cases, a small group of families. It is not a bank. It is not a hedge fund. It is not a financial advisory firm. It is a dedicated, bespoke institution built specifically to manage, protect, and grow one family's wealth across generations. The services a family office provides go far beyond investment management, tax planning, estate planning, legal structuring, philanthropy management, family governance, next generation education, concierge services, risk management, art and collectibles advisory, real estate management, private equity deal sourcing. In some cases, family offices employ dozens of specialists, lawyers, accountants, investment professionals, tax advisors, real estate experts, all working exclusively for one family. The scale of what family offices manage is staggering. According to estimates from Campton Wealth, there are approximately 10,000 single family offices globally, managing a combined total of somewhere between $5 and $6 trillion in assets. That is more than the entire hedge fund industry. And unlike hedge funds, family offices are almost entirely invisible. So why do families with extreme wealth choose to set up a family office rather than simply using private banks or wealth management firms? The first reason is control. When you use a private bank or a wealth management firm, you are one client among many. The bank has its own products to sell, its own fee structures, its own conflicts of interest. A family office has one client, the family. Every decision is made purely in the family's interest, with no external commercial pressure. The second reason is access. Family offices have access to investment opportunities that are simply not available through any retail or even institutional channel. Direct co-investment in private equity deals alongside major funds. First look rights on prime real estate acquisitions. Seed investment in early stage companies through proprietary networks. Club deals with other family offices on large alternative asset transactions. The network effects of a well-connected family office compound over decades into an extraordinary deal flow advantage. The third reason is cost. This sounds counterintuitive. A family office is expensive to run, often costing between $1 and $5 million per year in operating expenses. But for a family managing $100 million or more, the fee savings versus a private bank, which might charge 1 to 2% annually, quickly exceed the operating cost. At $500 million under management, 1% in fee savings is $5 million per year. The family office pays for itself. The fourth reason is generational continuity. A family office is not just an investment vehicle, it's an institutional structure designed to transmit wealth, values, and financial discipline across generations. It educates the next generation. It manages family governance, the rules and processes by which the family makes collective decisions. It creates the infrastructure that prevents the well-documented phenomenon of generational wealth destruction. The shirt sleeves to shirt sleeves in 3 generations pattern that sees family fortunes dissipated within a century. How do family offices actually invest? This is where it gets interesting, because the family office investment philosophy is fundamentally different from what retail investors are typically taught. The typical family office portfolio looks nothing like a standard 60-40 stock and bond allocation. According to the 2023 Campton Wealth Global Family Office Report, the average family office allocates approximately 27% to private equity, 19% to public equities, 15% to real estate, 11% to hedge funds, 8% to private credit and smaller allocations across commodities, infrastructure, and cash. The dominance of private markets in family office portfolios is not accidental. It reflects a fundamental insight that we have discussed throughout this channel, that the illiquidity premium, the information advantage, and the low correlation to public markets that private assets offer are features, not bugs, for investors with genuine long-time horizons. Family offices also tend to be more concentrated than institutional investors. They take larger positions in fewer assets. They back founders and operators they know personally. They hold positions for decades, not quarters. This is patient capital in its purest form. Capital that does not need to be marked to market every day and does not face the quarterly redemption pressure that governs almost every other type of institutional investor. The results speak for themselves. According to the same Campton Wealth report, single family offices delivered average net returns of 15.9% in 2023, significantly outperforming most institutional benchmarks. Over longer time horizons, the compounding effect of superior returns combined with low fees and concentrated high conviction positioning creates a wealth advantage that is extremely difficult to replicate. So what does this mean for investors who do not have the $100 million typically required to establish a single family office? The first lesson is philosophical. The family office model embodies a set of principles: long time horizon, private markets focus, concentrated positioning, low fees, multi-generational thinking that any serious investor can adopt regardless of their portfolio size. These principles are not exclusive to the ultra-wealthy. They are available to anyone willing to apply them with discipline. The second lesson is structural. Multi-family offices, institutions that serve multiple ultra-high net worth families within a shared structure, have lowered the minimum required to access family office-style investment management to somewhere between $5 and $25 million. For investors below that threshold, a growing ecosystem of platforms, funds, and vehicles is making family office quality alternative asset access available at progressively lower minimums. The third lesson is observational. Watching what family offices do, where they allocate, what sectors they are entering, what geographies they are focusing on, it provides an extraordinary signal about where sophisticated long-term capital sees value. Family offices do not follow consensus, they lead it. And the investor who understands their positioning before the rest of the market catches up has a significant informational advantage. The family office is not just a wealth management structure, it is the institutional expression of everything this channel covers: patient capital, private markets, alternative assets, multi-generational thinking, and the systematic rejection of the conventional financial wisdom that keeps most investors from building truly exceptional wealth. Subscribe to Capital Above Convention for weekly deep dives into the assets, structures, and strategies that the world's most sophisticated investors use to build and protect wealth. And I'll see you in the next one.